Hello, everybody. How are we all doing today? Welcome back to another video of Investment Talk with Justin. So, in this video today, I'm going to be talking about the three. I picked out about three ETFs, an exchange traded fund that can help for long-term successful growth, and it allows you to, get into a broad range of stocks rather than just investing into individual stocks that are more volatile. So, if you're more of a safe investor, ETFs are the way to go if you don't want as much risk. These ETFs are a way to track a broad range of stocks in the market without investing into an individual stock such as, let's say, Apple or Tesla. So if Apple goes down 5% in one day, Tesla goes down 6%, but then other stocks like Amazon and Google are up 1-2% on the day, it compiles an average of all those stocks and however they're weighted in that ETF. So for the first ETF that I've picked out here today is a very simple one. Everyone should own this ETF in retirement funds, regular portfolios, whatever. This is a very common one that you definitely should have is VOO. There's other S&P 500 ETFs, but VOO is personally what I choose. But so as you can see here, all it does is track, the S&P 500, so when looking at an ETF like this, we see obviously here something like the S&P 500 that goes up on average, they say 8 to 10% a year for the past 50 years on average. An ETF here, 5%, 108%. So you've already would have doubled up on your money in over 5 years. So whatever you invest long term is going to grow. Obviously, there's volatility. Obviously, we're in a little bit of a feared market right now, but these are times where best times to buy, in my opinion. So as you can see here, the last month's up minus 7%. 6 months only up 0.17, but then year to date it's minus 4. Last year up 10. See, there's your average right there. And last year, 8 to 10%. Last 5 years, 108. So when I like to look at an ETF, I look at the expense ratio. So this is how much it's going to cost you in about a year that they take out as doing, because you're investing into a fund. So it's going to cost 0.03% of your investment a year, which is very little. You honestly shouldn't even notice it being taken out, because you get on average at least the S&P 500 ETF, you're going to be getting at least 8 to 10% on average for the next, let's say 10 plus years. So that is here. VOO is one that I personally invest in. I like, and I think that every investor should have in their portfolio for long-term financial success. And all the great stuff that can come along with financial freedom. Real quickly, I also wanted to show this is another one that's not by Vanguard, it's by Spider. It's basically the same exact thing. It's another ETF, but the reason why I like VOO more is because if you look at these expense ratios, the last one was 0.03%. This one here is 0.09. So you're paying a little bit more. It's still a very minute, but you're paying a little bit more for practically, the same thing. It's just all based on preference. If you like SPY versus VOO, there's really no difference. This one still is 9.2%. It's all and however the stocks are weighted. So let's take a look over here at holdings. As you can see here, this is how the ETF is weighted. So SPY I'm showing right now, it's Apple is 7% of it. You have Nvidia. So you're investing in all these companies in this one ETF rather than individually investing in Nvidia and having to choose. You get all of these top 500. And it's about the same thing as VOO too. Maybe the percent assets is a little bit different in VOO, but it's all the same companies, the top 500. All right, guys. So the next ETF that I think everyone should have in a portfolio for long-term financial success is the SCHD, Schwab US Dividend Equity ETF. This one is a little bit different than VOO. So obviously, as you can see here, the past year, it's only up 5%, but this is more of a compounding type of ETF because the dividend that it gives great dividend. As you can see, the yield here is 3.49%. So you're going to be basically doing some compounding. We have also only an expense ratio of 0.6%, so it's also a very cheap ETF. This one tracks all the heavy dividend stocks in that are publicly traded. So for this one is always great because it's just compounding. Compounding over time, if you're investing $100 a week, $100 a month, whatever you can afford, over in the long run, stocks always go up, right? And something like this that gives you dividends. All right, so everyone, so I have now put up the chart. So I did a year view here. So you get a dividend paid out every 3 months, but it's a higher dividend ratio than like other ETFs because this is literally a dividend equity ETF. So you have a compiled of all the top stocks that pay out the highest dividends. And then what you would do, like I said earlier, you would do a dividend reinvestment program and then just compound and keep adding over time. And also just to give you guys a little bit of a background also on this dividend equity ETF, these are the stocks that you would be holding. These are the top 10 holdings of it. AbbVie, Coca-Cola, Amgen, Cisco, Pfizer, Verizon, the list goes on. Very stable, good companies that pay out great dividends. Hence why this is the best dividend ETF, in my opinion, that I personally own and is great for compounding long-term financial growth. All right, everyone. Last but certainly not least, another very safe ETF to buy and add into a long-term portfolio is VTI. It's a total stock market index. So this one literally has the entire stock market in one ETF rather than you having to invest in however many single stocks are, over 3,000, something like that. I could be wrong, but it's an insane amount that you definitely should not have in your portfolio. But here, as you can see, stock market average returns, like I said, 8 to 10% a year, 8% there. Last 5 years, 103%. So obviously, there's that short-term volatility here, year by year, but in the long run, stocks, they always do go up, as you can see. So VTI is a great one, and it has an expense ratio of only 0.03%. So again, very little. You won't even probably realize the money taken out of your account. So yes, VTI, very safe, great for long-term growth. This is the third ETF that I want to talk about in this video. Let's go over here and let's check out the holdings on it. As you can see, similar to VOO, except VOO only has the top 500, whereas VTI is more of the total stock market. But as you can see here, Apple, Microsoft, once again, the top best performing companies. Obviously, you can pick and choose what ETFs you have in yours. You don't have to have all three of these, but I mean, this is the most safest way. If you only want VOO, that's honestly perfectly fine as well. If you only want SCHD for compounding dividend growth, that's perfectly fine as well. But all these are long-term, keep adding no matter what. Every dip, every gain, every week is the best way to have long-term growth in these because 8 to 10% a year, if you're investing even $100 a month, think about it for the long run. So that's going to wrap it up for this video. I hope you guys enjoyed. If you did, subscribe, hit a like button, leave a comment. If you have any suggestions, anything you want me to go over or anything that you want me to talk about, leave it in the comment section down below. And thank you for watching this investment talk, and see you guys in the next video.